Hello, everyone, and welcome to Economics Decoded. Something major happened this week. Kevin Warsh made his first appearance as the new chair of the Federal Reserve, and the philosophy and policy leanings he revealed caught the market completely off guard. What could this mean for the future of America's AI bubble? Today, we're taking a deep dive into whether AI is creating another enormous bubble, how this one differs from the biggest bubbles in history, and whether it will follow the same old script from frenzy to collapse. If the AI bubble does burst, what would trigger it? And under the new Federal Reserve Chair's policy approach, will it keep expanding or gradually shrink and finally pop? What is a bubble, and how does one form? Let's begin with what an asset bubble actually is and the conditions that create one. When we say an asset is in a bubble, what do we mean? We mean that the future income the asset is expected to generate, discounted back to the present, is far below its current price. Take a house worth $1 million that produces only $15,000 a year in rent. Is that a bubble? Of course it is. The return is just 1.5%. You would be better off buying treasury bills. But deciding whether a technology company is in a bubble is much harder. Take SpaceX. The skeptics say the company is still losing money. Its plan to build data centers in space has barely gotten off the drawing board. Even if it can be done, it may be 10 years away, and even then it may not be especially profitable. Yet the company is already being valued at $2.6 trillion. That is a bubble, and a huge one. The other side says, you're thinking too small. You're short-sighted. You have no imagination. 10 years ago, could you have imagined Elon Musk building reusable rockets? 15 years ago, would you have believed he could build Starlink? 20 years ago, could you have pictured him creating Tesla's electric cars? Musk is one of the smartest and most capable entrepreneurs in the world. Data centers in space will surely become reality, and quickly. SpaceX will become the beachhead for humanity's expansion into space, like the East India Company during Europe's colonization of Asia 200 years ago. One day, it could monopolize the entire business of space settlement. You cannot value a company like that with a calculator based on what it earns today. You have to look toward the stars. At today's price, it is still cheap. Its future market value could reach $10 trillion. See the problem? It is much harder to judge whether a high-tech company is in a bubble than whether real estate is in one, and much harder to reach a consensus. The biggest question is this: can you predict the speed of technological progress? Can you know whether the business a technology company describes today will become real next year, in 3 years, 5 years, or 10 years? Can you predict how much revenue it will generate? That is extremely difficult, and that is exactly why technology companies are so prone to bubbles. When people are optimistic, they can imagine a company reaching the sky while ignoring every problem in front of it. In the previous episode, we looked at 6 major technology bubbles. Every one of them formed because people became excessively optimistic about a new technology and convinced themselves that its brilliant future was about to arrive. But optimism about a new technology is not enough by itself. To create a truly massive bubble, you also need easy monetary policy. Why? Because low interest rates and an expanding money supply give optimistic investors access to cheap capital. With money so inexpensive, speculators can keep borrowing from financial institutions or even from friends and family and pour that money into the stock market in pursuit of a technology-driven fortune that seems just within reach. Where the AI bubble stands today. Now let's look at the current AI boom. What it looks like today, what it has in common with past bubbles, and what is different this time. The force driving this AI boom is the enormous progress in artificial intelligence itself. AI began making a visible leap toward becoming a practical technology around 2012. That was when Fei Li, the Chinese-American computer scientist, was leading an image recognition competition. She invited AI research teams to compete using the image database she had built and see whose model could identify images most accurately and intelligently. After several rounds of the competition, one team's neural network model achieved a breakthrough in 2012 and crushed the runner-up. That result showed humanity a promising direction for AI. From then on, artificial intelligence advanced rapidly along that path, iterating at extraordinary speed. One detail is worth mentioning. The winning team used graphics processors made by a small company called Nvidia, because GPUs were faster at matrix calculations. Just imagine if Fei-Fei Li or anyone else had understood what Nvidia would become and bought the stock back then. By now, that investment would have multiplied 665 times. From 2012 to 2022, I was already developing quietly in the background, but relatively few people understood what was happening. Then ChatGPT was released in 2022, and Wall Street's enthusiasm for AI exploded. Suddenly, people could see how powerful it was. It could talk to you almost like another person. Investors rushed into AI companies, especially Nvidia. OpenAI was not publicly traded, but institutional investors chased it just as eagerly, pushing its valuation to one record after another. Other companies, such as Palantir, attracted enormous enthusiasm as well. There is no question that artificial intelligence is a profound revolution. It is already raising human productivity dramatically. AI's coding ability now surpasses that of many programmers from the past. Doctors can use it to analyze medical images faster. Engineers can use it to help design complex products. Researchers can screen vast bodies of literature and accelerate drug development. Teachers and students can receive personalized instruction and tutoring. AI will fundamentally transform the structure of the global economy. That much is beyond doubt. And in that respect, this is exactly like every major technology bubble in history. The underlying technology is real and revolutionary. To understand whether AI is in a bubble and how large that bubble may be, we first need to understand the AI supply chain and how money and demand move through it. At the center of the AI revolution are model training and inference. The more an AI model is trained and iterated, the more capable it becomes, and the more human tasks it can perform. That is the core engine of the entire industry. The most representative companies doing this today are OpenAI, Anthropic, and others like them. Their models are genuinely revolutionary and have already produced real value. Because these companies see an enormous future market, they keep raising money and spending aggressively on data center capacity. But for now, they are not profitable. They're losing money. To train their models, these companies need vast amounts of data center capacity. They can build it themselves or rent it from someone else. Data centers sit upstream, supplying the computing power needed for training and inference. Who builds them? Technology giants such as Microsoft, Amazon, Google, and Meta, along with a new generation of specialized data center companies. To secure the gateway to the AI era, the tech giants may spend several $1 trillion over the next few years building data centers and buying GPS, servers, networking equipment, and electricity. Then there are pure-play data center builders, including major names such as CoreWeave and Nebius. And there is another player to which the market has assigned an enormous amount of imagination: SpaceX. Many investors believe SpaceX can use its rockets to launch chips and other materials into orbit, build vast data centers in space, train and run models there, and transmit the results back to Earth through Starlink. They argue that orbital data centers could receive solar power 24 hours a day without consuming land or straining terrestrial power grids. In this vision, SpaceX is no longer merely a rocket company. It becomes the builder of the infrastructure for a future digital civilization. Upstream from the data center builders are two main groups of suppliers: chip and networking equipment companies and power suppliers. The chip makers are the classic picks and shovels businesses. Nvidia supplies GPS. Samsung, SK Hynix and Micron provide memory chips. TSMC manufactures the chips. These components are the heart of a data center, providing its computing power. Broadcom supplies high-speed connectivity, while Vertiv provides power management and cooling equipment. Then there is electricity. Data centers consume an extraordinary amount of power. In energy efficiency, today's AI models are nothing like the human brain. The brain uses only about 20 watts, roughly the power of a small light bulb. Training an AI model, by contrast, can require tens of megawatts or tens of millions of watts. That is a difference of several million times. AI data centers therefore require enormous additions in power generation and major expansion of the grid. The entire supply chain looks like a giant pyramid. This transmission mechanism is the same one we have seen in every technology bubble. During the dot-com bubble in 2000, internet companies at the bottom of the chain initially looked extremely promising. Companies such as Yahoo and Netscape raised money aggressively and bought telecommunications and fiber network services. That encouraged companies such as WorldCom, Global Crossing, and Quest to spend heavily on undersea cables and nationwide fiber networks. That infrastructure boom, in turn, produced huge profits for Cisco, which made the routers and switches used in those networks. Cisco played a role much like Nvidia's today. It was the picks and shovels company of its era. Unfortunately, the internet companies at the front end never found a reliable business model. They burned through cash to generate clicks, but could not generate profits. When financial conditions tightened, their funding chains snapped. They could no longer raise money, and the bubble collapsed all the way up the supply chain. Now that we understand the chain, let's ask how inflated AI valuations are today. Start with Nvidia, the biggest profit machine. Nvidia currently has a market value of $5 trillion and a price-to-earnings ratio of 31. That means its share price is 31 times the net income it earned over the past year. Put differently, if its annual profit never grew, it would take 31 years of earnings to equal the price investors are paying today. Is that expensive? For a company whose future profits are certain to keep growing, it is not unreasonable. The problem is that Nvidia's future profit growth does not appear certain enough to justify complete confidence. Move farther upstream to TSMC, which manufactures Nvidia's chips. Its PE ratio is 44, even higher. That reflects today's chip shortage. Data centers are expanding downstream, while upstream manufacturers are working flat out and still cannot make chips fast enough. Micron, which produces memory chips, trades at more than 50 times earnings. Now compare those figures with Cisco during the dot-com bubble. Cisco was the picks and shovels company of its day, much like Nvidia now. What was its PE ratio? More than 100. That is still more than 3 times Nvidia's current multiple. This is one of the most important differences between today's AI boom and the dot-com bubble. Valuations for the picks and shovel stocks are nowhere near as extreme as they were last time. Next, consider the data center builders. Today's market consists of 2 very different groups. The first is made up of deep-pocketed, established internet giants such as Microsoft, Google, and Amazon. Their legacy businesses generate tens of billions or even more than $100 billion in annual profit. Most trade at roughly 27 or 28 times earnings. For monopoly-like giants with extremely stable cash flow, those valuations are not outrageous. They are reasonable, perhaps a little high, but nowhere close to bubble territory. The second group consists of young, pure-play data center builders. The 2 largest examples are CoreWeave and Nebius. CoreWeave has more than $5 billion in revenue, a loss of $1.2 billion, and a market capitalization of $62 billion. Nebius is expected to generate more than $3 billion in revenue in 2026, probably at a net loss, while carrying a market value above $70 billion. And the most extreme case, of course, is SpaceX. It talks about building data centers in space, even though nothing of the sort exists yet, and it is already valued at $2.6 trillion. Do you see the divide? The mature technology giants do not appear to be in a bubble. But among the new data center builders, share prices have become severely disconnected from the profits investors can reasonably expect. This looks remarkably similar to the network builders of the dot-com era. Back then, the established telecom giant AT&T did not reach an especially absurd valuation. As America's largest telecom operator, it had stable cash flow, a mature customer base, and real earnings. The company's investors chased most aggressively were the upstarts, WorldCom, Quest, and Global Crossing. They offered an irresistible vision. Internet traffic would grow 100-fold, then 1,000-fold. The world would need endless new fiber networks and undersea cables. Capital markets kept feeding them money, and the companies kept borrowing, expanding, and building infrastructure at a frantic pace. Their revenue was limited, their profits were negative, yet their valuations reached tens or hundreds of billions of dollars. Most eventually went bankrupt or were acquired, and some resorted to accounting fraud. Does that sound familiar? Especially in the case of SpaceX, where the vision is still largely a promise. It should make investors a little nervous. Now, look at the front end of the chain, the AI model companies. The two giants are OpenAI and Anthropic. OpenAI generated $13 billion in revenue in 2025 and lost $20 billion. In 2026, it is expected to generate $23 billion in revenue and lose between $14 billion and $20 billion at a valuation of $850 billion. Anthropic's numbers are even more striking. Its projected 2026 revenue is between $40 billion and $50 billion, with a possible loss of around $10 billion at a valuation of $960 billion. These companies can be compared with front-end internet businesses from 2000, such as Yahoo, Netscape, and Amazon. Yahoo had $1.1 billion in revenue, $70 million in net income, and a market value of $120 billion. On the surface, doesn't the situation look quite similar? And doesn't it suggest that the bubble at this end of the chain may already be very large? The model companies are not profitable, but the enormous sums they spend on computing capacity are real money. That cash flows directly to data center builders and to the companies supplying chips and electrical equipment. Nvidia, with its near monopoly in GPUs, has made an extraordinary amount of money. Last year, it generated $216 billion in revenue and $120 billion in net income, supporting a market value of $5 trillion. But whether that can continue ultimately depends on whether the AI model companies can produce astonishing models, sell them to businesses and individuals, and earn enormous profits. If they cannot generate enough revenue and earnings, and if it turns out that no powerful business model can be built in the short term, then their huge spending on data center capacity will be unsustainable. It will shrink, and the chip makers, electrical equipment suppliers, and data center builders upstream will all suffer. Even so, we still cannot conclude with 100% certainty that today's model providers and data center builders are severely overvalued. We cannot know whether a remarkably powerful new model will suddenly appear next year, next month, or even next week. That brings us to another major difference between this AI wave and the dot-com bubble: the speed of technological iteration. Progress today is far faster than internet technology advanced around the year 2000. Since OpenAI released GPT-4, we have seen GPT-5, Gemini 3, Anthropic's Claude, OpenAI's Codex, and the recently released Fable 5, which was restricted by the U.S. government soon after launch because it was considered too powerful for unrestricted use. The technology is advancing at an extraordinary pace. Every few months, something new leaves the public stunned. Why is technological progress so fast today? It follows the natural pattern of technological development. At its core, Progress is a process of entropy reduction within Earth's open system, and that process develops exponentially. Humanity spent millions of years in the Stone Age, 3,000 years in the Iron Age, 200 years in the machine-industrial era, and only about 30 years in the Internet era. Yet the age of artificial intelligence has been unfolding for just 3 years, and its speed is almost impossible to compare with anything in the past. If you project that exponential rate forward, today's model companies may improve much faster than we expect. Achievements that once took more than a decade may now arrive in a few years, or even change dramatically within a few months. Companies that look wildly overvalued today could see their revenue surge in a matter of months or a year or two. Their business performance could grow into today's valuations. Once you account for that possibility, do the model companies and data center builders that appear so inflated really look as extreme as the internet companies of 2000? Perhaps not. They may still be a considerable distance from that point. There is one more enormous difference between today's AI boom and the dot-com bubble: the electricity bottleneck. This AI revolution consumes an extraordinary amount of power, far beyond anything people previously imagined and far beyond the electricity currently available. A large AI data center campus may require a continuous supply of 500 megawatts to 1 gigawatt. A large nuclear power plant typically generates only about 1 gigawatt. In other words, a single hyperscale AI data center can consume the output of an entire power plant. The United States generates roughly 4.3 trillion kilowatt hours of electricity a year. Data centers already consume about 5% of the nation's power, and by 2030 that share could rise to 10 or even 12%. California is America's largest state economy, and by 2030, AI alone could consume as much electricity as 1.5 Californias. A very large share of future growth in U.S. electricity demand will be swallowed by artificial intelligence. PJM, one of America's largest grid operators and the organization serving 13 eastern states, has reported that projects waiting to connect to its grid total hundreds of gigawatts, with a large share related to data centers and AI. But expanding the power supply is an extremely slow process. Unlike manufacturing more chips, the power system is capital-intensive physical infrastructure. From site selection and permitting to financing, construction, and grid connection, a large power plant often takes 3 to 5 years to begin operating. A nuclear plant can take around 10 years. Even after a plant is built, its electricity has to reach the data center through transmission lines and connect through substations. The true bottleneck is often not generation itself, but grid expansion, which can take even longer than building a power plant. Many U.S. AI data center projects today have plenty of capital and land. What they lack is permission to connect to the grid. That is why America's technology giants are searching for breakthroughs in small modular nuclear reactors. In theory, they could build a small reactor directly beside a large data center and avoid the grid connection queue. But the technology is still immature. Who knows whether it will take another 5 years or another 10? The dot-com bubble faced no comparable bottleneck. Companies could invest heavily, lay fiber, and complete projects within months or a year or two. That is one reason the bubble inflated almost overnight. This time really is different. In fact, it may resemble the build-out of the railroads and later the electric power system more than the internet boom. From 1830 to 1890, railroad construction in the United States continued for more than half a century. Because investment was spread across 60 years, the economy experienced several railroad booms and busts, including the crises of 1857, 1873, and 1893. The crises of 1873 and 1893 were the most severe, and the final one was the worst. By then, America's rail network was largely complete, but redundant construction was rampant and price competition was brutal. After the bubble burst, one quarter of U.S. railroads entered bankruptcy proceedings. In the same way, power constraints will limit the pace of AI investment. The boom may not be able to race to a peak in 1 or 2 years and then suffer a single spectacular collapse, as the dot-com bubble did. A more likely outcome is a series of investment booms, smaller bubble bursts, and corrections extending over 10 or even 20 years. Of course, over such a long period, AI technology may advance even faster than power plants can be built. Could excessive optimism eventually create a much larger bubble? That is a question for the years ahead. Now let's turn to the monetary side. In the previous episode, we explained that every bubble collapse has been accompanied by tightening liquidity. In practical terms, that means rising interest rates and a shrinking money supply. By the same token, every great bubble has formed under easy liquidity. When rates are low, borrowing and financing are cheap, and investors can raise enormous sums for investment. So what kind of liquidity environment does the AI boom face today? At the moment, liquidity is neither especially loose nor especially tight. The Federal Reserve's policy rate is currently between 3.5 and 3.75%. That is not high, but it is not low either. Under the scenario markets expected in 2024, if there had been no tariff war and no war with Iran, U.S. inflation would likely have fallen by now, and interest rates would have fallen with it, perhaps to 3% or lower. In that world, we might already be inside an epic bubble. But the world changed quickly. The tariff war and the war with Iran pushed prices higher. Rate cuts vanished from the agenda, and rates could not continue falling from their current level. That delayed the formation of a huge AI bubble. A fast bull market became a medium speed or slow one. Even so, today's rate level is not especially restrictive, and the cost of capital is not prohibitively high. AI investment will therefore remain hot. Large amounts of money will continue flowing into the industry, and the bubble will keep expanding. More recently, the war with Iran produced a memorandum on peace negotiations. The agreement gave investors considerable confidence that peace could return and that free navigation through the Strait of Hormuz could be restored. That would suggest inflation may peak and begin falling over the next few months as supplies of oil, fertilizer, sulfur, natural gas, and chemical products gradually recover. The recent period of stagflation could then pass within a matter of months. That is the market's optimistic scenario, and reports of the memorandum were followed by a wave of enthusiasm and a rapid market rally. I do not think we should be too optimistic. We need to remain highly alert to stagflation for 4 reasons. First, there's a meaningful chance that the Iran issue is not over. One of the memorandum's most important provisions says that the United States and its partner countries will invest at least $300 billion in Iran's reconstruction. But anyone looking at this realistically can see how difficult that would be. Who would invest in Iran? The U.S. government is unlikely to do it. Congress would never approve it. Would private companies go? Would you? If a company spends huge sums rebuilding Iran's public infrastructure, where does the return come from? The Iranian government will not pay it. The U.S. government will not pay it. Even if the project were a toll bridge, how many companies would dare to build it in Iran under these conditions? So the promise sounds largely like an attempt to placate Iran. But the Iranians are not naive. If the other side promises investment and then fails to deliver, Iran can say the agreement has been violated and return to enriching uranium or controlling the Strait of Hormuz and charging for passage. My sense is that this was a hastily patched-together agreement designed to relieve inflation pressure, but with very limited practical feasibility. There is a significant chance of new trouble. If that happens, and the Strait of Hormuz remains disrupted, hopes for the end of stagflation could collapse. Second, there is the food problem. After months of disruption, the planting season has already passed across much of the Northern Hemisphere. Fertilizer shortages will inevitably show up in agricultural output. When crops are harvested in the second half of the year, food prices may rise. making it even harder for inflation to fall. Third, the new Federal Reserve Chair has taken an unmistakably hawkish position. In Kevin Warsh's first appearance a few days ago, he made 3 points very clearly. First, the war with Iran has created inflation, so rates cannot be cut now. That is the consensus. Second, he firmly repeated that 2% remains the Federal Reserve's inflation target. If you doubt the Federal Reserve's resolve, he warned, you will lose money in long-term bonds. Third, the dot plot shows that half of Federal Reserve officials believe a rate increase may be necessary this year. The message to markets is clear. If inflation persists, rate hikes are an available response. Fourth, according to my calculations, America's prime-age labor force population will rise sharply after 2027. Viewers who have watched my previous episodes on demographics will know what that means. The U.S. economy will generate stronger demand from within, adding upward pressure to inflation. So, putting all of this together, here is my personal assessment. First, the bubble may continue expanding for some time, because a rate increase still appears unlikely over the next 2 or 3 months. Second, if we extend the horizon to several months, half a year, or more than a year, I believe the probability of higher rates remains meaningful. In one sentence, it is too early to predict that the bubble is about to burst, but we should stay alert over the next 6 to 12 months. Watch Iran. Watch food prices. Watch demographics. In other words, watch inflation. The moment the market develops a firm expectation of rate hikes, there is no need to overthink it. A cyclical correction is coming. Of course, that will also create opportunity, because this AI boom is likely to continue for many years. All right, my friends, if you enjoy the show, please like, subscribe, and share it with your friends so that more people can discover useful and interesting insights about economics and finance. Disclaimer: this content reflects only the author's personal research and opinions based on publicly available information. It is intended to share economic research and does not constitute investment advice in any form. Any investment decision should be based on the investor's own financial circumstances, risk tolerance, and independent judgment, with advice from a licensed professional when appropriate. The author has made every effort to use reliable sources, but does not guarantee their completeness, accuracy, or timeliness, and accepts no responsibility for any direct or indirect loss arising from the use of this content. Thank you for watching, and I'll see you in the next episode.